It looks like we're live,
Oh
which
boy.
means this is Value After Hours. I completely forgot what it was that we were doing here. It's Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Ben Beneche, and his firm is Tourbillon Partners. How did I go with that pronunciation, Ben?
Spot on, Tobias. That's nailed it.
Do you want to give us the authentic French version of
Yeah, we'll go with tourbillon.
there we go,
Ooh.
tourbillon. That sounded much better when you said it. I should have had you introduce it.
Yeah.
Ben, welcome to the show. Would you please give us a brief introduction to Tourbillon and yourself, and we'll go from there.
Yeah, sure. So tourbillon is an offshore fund. We invest globally in pretty small number, 15 to 25, what we view as durable businesses. We skew sort of smaller and mid-size in most of the companies we look at. Now that's not necessarily by design. We kind of try and step away from standard definitions of small and mid cap or growth and value. But simple reality is 70,000 companies listed globally. There's more small ones than big ones. So that's where we've tended to find opportunity. And we're also invested pretty heavily outside of the US. So only about 20% of the strategy today is invested in US listed companies, about 45% in Europe, and I'm including the UK in that number, and around 20% in Japan. And then there's a few characteristics that we look for in order to find durability. We don't start with quantitative backward-looking measures. We have a couple of what we think are pretty core fundamental truths. One's built around the idea of scale. We call those symbiotic loops, but typically found in businesses like in certain retailers, certain low-cost financials, where they have a real scale advantage and share that with the customer. And then the other idea is around scarcity. We call that fulcrum assets, but basically companies which offer product or service that has no close substitutes in the eyes of customers. So that can be tangible. Tollbridge is obviously the usual example, but it can be metaphorical. It can be a certain brand. So that narrows down the 70,000 companies to a more manageable list, a couple of hundred, which we feel we understand and are good representations of those ideas.
And when you construct a portfolio, what is a sizing at initiation?
Yeah.
How big would you let something get? What's the criteria for buying and selling and so on?
Yeah, so I mentioned 15 to 25 investments total. That's pretty top end skewed. So 80% of the assets are in the top 10 investments. Then we think there's some value to having a tail of smaller investments where sort of reduce the mental friction associated to being able to increase or decrease the size somewhat quickly. That's a behavioral element as opposed to a purely rational type of thing. But the sizing beyond that is driven by our approach to valuation. We like to see cash flows up front as opposed to somewhere in the ether. So we just think about basically normalized free cash flow yield this year or next at the very latest. We call that owner earnings, but it's pretty much synonymous. And we're looking to buy things at an owner earnings yield somewhat better than effectively what our opportunity cost is. For us today, that's around 6.5%, things that we understand and pass our criteria, but it definitely has to be better than long-term cost of money. So call it 4% today in the US, 5% very, very long term. So we're trying to buy a lot better than that and sell when you're getting down to the 3% type of range. So sizing is a function of that valuation. And then we also implement a checklist. So borrowing from Danny Kahneman's System 1, System 2 type of thinking, we're trying to bring some of these things that count, that can't be counted, into the realm of something we can make sense of and actually quantify, or at least form a discussion around. And that checklist is sort of married with evaluation to bring us an idea of where we should be sizing, or at least what we should be thinking about when it comes to sizing decisions.
And Ben, in your letters, you have this cool chart that shows like entry and exit based on earnings yields. Maybe could you explain that and like what the thinking is behind it?
Yeah, so we tend to buy things on average at around the 7.5 or an 8% owner earnings yield. We've been selling things when they get to around the 3% type of level. So although our primary filters, the way we get from 70,000 companies down to a more manageable number is more qualitative. It's about business endurance more than anything else. Beyond that, valuation is an important component, and that's where we're really thinking about that owner earnings yield plus the long-term growth of the business to drive our return. We're not counting on, a certain cap rate at some point in the future or a multiple. We want the business to do the heavy lifting for us, and really that's the thinking around it.
Ben, we're getting a note that you're a little bit quieter than us. Is there some way you can
Yeah, I can.
boost your mic a little bit?
I totally. Let's try that. If not, I'll just speak up.
Just project.
Yeah.
Durability is something that I'm particularly interested in, but how do you think through durability? What are the sort of indicia of durability?
So look, it's those two ideas I mentioned are the two that really count to us. So it's really putting yourself in the shoes of the customer and the only way we feel you can create durable value in the world today is pretty much through having real value for the customer. And then it comes back to these ideas of scarcity or scale. Is something better? So you're willing to pay more for it over time, and that's in the eye of the beholder. But a Birkin bag, I don't know. My wife would probably suggest it's worth quite a bit of money. But then
Exactly what you have to pay for it.
I don't agree on the value that she ascribes to it, but again, there's a market for it, right? And they carefully nurture that brand. Hermes famously a few years ago had a very successful line that was made out of cloth and sold for a few $100. It was incredibly successful. Instead of pushing the foot on the accelerator and selling more of them, they cut the line because it was diluting the brand. So you want management teams who really understand what they're sitting on and nurture that advantage they have over the long term instead of profit extracting today. And the same goes for the scale advantage, whereas, the idea of scarcity is something better. Scale is something cheaper. Everyone knows the example of Costco. I'm not going to talk about valuation there, but the reality is the company runs at a 12 or 13% gross profit margin. That's probably close to 8 points better than even Walmart, but much better than most other people. They're not profit maximizing. They're reinvesting over the long term and preserving that value proposition. So when we're thinking of durability, we're thinking of companies who have that advantage and then have a stewardship team, a management team, who are nurturing that advantage. And that looks a little bit different in different sectors. I think the hallmarks of seeing that, I don't think there's a screen that can really give it to you. It takes a degree of experience in individual industries to get that insight. But that's really what we're looking for. Now, a history of having done it for a long time is great. Everyone's kind of familiar with the Lindy effect. If something has lasted for a while, it's likely to last going on into the future. That's also great. But we focus more on those first principles more than anything else.
What do you look for with management?
Look, skin in the game is great, but really we want management who have an intangible insofar as they're obviously thinking for the long term. They're willing to make those trade-offs, which are maybe hard today, but which are in the long-term benefit of the business. So the obvious thing is management teams who don't employ too much leverage. In the US, almost every company we look at is optimized to within an inch of its life in many cases. It's great while it lasts, but you have a small hiccup, and it's one thing that you learn, I think, when you've done this business for even a short period of time. You realize that black swan events, 25 standard deviation away from the norm stuff happens all the time. And you don't want management teams who are going to stumble at the first hurdle. So it's a conservative balance sheet. It's skin in the game. a history of strong capital allocation. On the intangible side, it's management teams. What I'm kind of a sucker for is management teams who talk themselves down. I remember Mark Leonard for years would say how expensive his stock is. It might be now. It probably wasn't 10 or 15 years ago, with the benefit of hindsight, looking at how cash flows did kind of evolve over time. And management teams who talk down their prospects, talk about their failures as much as they talk about their successes. These are intangibles that are actually quite rare. I can count on the two fingers of two hands and maybe my toes, the number of management teams who actually do that.
I've discovered one little kind of hack, little secret tip in how management talks about the company or the assets. And they'll like, the worst is when they say my company, my assets, my, my employees, whatever. Next best is our company, our assets. That's a little bit better. And that's kind of what average looks like. But the best, and you'll hear Buffett when he's talking at the shareholders meeting, is he'll say your assets, your company, your employees. And I think there's a little bit of tell there in how the management even discusses their, what they're in charge of, that stewardship.
Yeah, that's totally true. I mean, if you're actually thinking about investing in public equities as a permanent owner, that's kind of how we like to think, and you're expecting to get your return from the business, you need to trust the people in charge, right? I mean, if you pay, let's say, a 6% earnings yield or free cash flow yield, and it's growing 6% a year, if you assume no exit value for that business, it's taking you well over a decade to earn a return and probably a couple of decades to earn a 10% IRR if you're just relying on the cash flows. And if you don't trust the people in charge to make that accrue to you in some way or another, some point in that journey, what's the point? You are in the greater fool game, and I don't really want to play that game.
It's been working pretty well for the last 50 years, that game.
There's always another fool right behind the.
Oh, I know.
Many more than any of us could have possibly imagined. Before you started Tourbillon, what was your background? How did you get to that point?
Yeah, so I'll start briefly right at the beginning. So, I was born and raised in France, French father, English mother. My father was an entrepreneur. He was a businessman. He was sort of, I guess, what you'd call a value-added reseller today in IT. But at the dinner table, we always talked about business and investment. That was sort of the common language we had, and I always found that particularly interesting. And I wasn't always the best student. I was a decent student, but I was always pretty handy when it came to business, economics, and history. And parlayed that into university, and then in 2008 joined a place called Pictet Asset Management, where I started as a young equity analyst, a generalist. Ended up specializing in oil and gas. This was when the oil price was running high at the 120s kind of level. And then in 2012,
you've seen it 120 to zero.
Yeah,
negative 35.
Yeah, well, exactly. I had brilliant timing with that one, because in 2012 I was asked if I'd like to become a portfolio manager on a pretty large, few $billion international equity fund with specific focus on the Japanese part of the fund. I was way too young for it, but no one else wanted to do Japan in 2012 before Abenomics. This was post Fukushima, lost a couple of decades. So I jumped at the chance, and then for the next 10 or so years of my career was pretty much focused on Japan. Eventually branched out and sort of became co-head of the international equities team. But a large part of my formative years was doing Japan during the 2010s and through to 2020. And then in 2022, decided I wanted to try and build a different type of investment operation alongside my partner, Ramesh. and we set out and built Tourbillon.
How's your Japan experience over that decade? I mean, I know it wasn't the most
Yeah.
tailwinds, but like value strategies over this entire 30 lost years they did just fine.
Mm-hmm. Yeah, I think for a long time in Japan, it was actually, I'd never call it easy, but I think if you looked at the broad landscape of Japan, it's around 4,000 or so listed companies. And outside of the top 100 or 200 very well-known large companies like Toyota, the trading companies, the banks, and then in the more kind of, let's say, quality type businesses like Keyence or Fanuc or something like that. Outside of that, there was a whole heap of really well-managed businesses domestically, which were trading at valuations that made absolutely no sense in relation to the intrinsic qualities of the business, mostly because
too low.
Too low, too
Yeah.
low. I mean, you were able to buy, some of the Japanese drugstores, for example, and in Japan, some of the drugstores really are more like the hard discounters in the rest of the world. They do a lot of food and sundries, but great businesses which for 50 years had probably never had a down year in terms of earnings per share, but traded on high single digit PE multiples. And for no other reason than the fact that they always had. And that's just the way it was. And so if you're willing to do a little bit of scuttlebutt research and look at those businesses from a first principles perspective, you could do really well, not just in a Japanese context, but relative to the S&P or any other kind of benchmark you may choose. So that was the context in which I started doing Japan, and it's still very much the case today. I think over the past couple of years, the small cap Japan index, the Mothers Index, has probably underperformed the Nikkei by, I'm going to throw a number out there, but it's directionally correct, 50%. Everyone's become very enamored with weak yen beneficiaries, companies which are restructuring, going from terrible to slightly worse. And it's left behind, again, a lot of these smaller domestic businesses, which are, in some cases, not all of them, don't get me wrong, but in some cases, very well run, great businesses.
Ben, I know that you're a native French speaker because only a native French speaker could say Hermes and not Hermes, which all the rest of us who don't speak French are compelled to say. In Japan, what's the JT? What was the name of the what do you call the very durable, the very long-lived?
Shinisei.
The Shinisei. Japan seems to have many more of that Shinisei style business than anyone else. I don't know why. Maybe it's because it's an island. I don't know why. Cultural, maybe.
Yeah, the history of Japan's really interesting. I mean, that kind of island Galapagos type syndrome, where they kind of became self-sufficient and built their own ecosystem. It kind of started in the 1650s, from 1650 to about 1850, when an American came along. He was called Matthew Perry, and basically said you have
Friends?
to start.
Oh, no, it's a different one. Yeah.
different Matthew Perry. But he came along and he basically said you've got to trade with the West. And he came with a few ships, and then he came with a whole armada of ships, and then that led to the whole Meiji restoration of Japan. But for 200 years, Japan was like totally isolated from the world. They did their own thing, and it's obviously very homogenous from an ethnicity and cultural perspective as well. So they've always emphasized their way, and they've always emphasized durability, and they've always, there's this collectivism in Japan, I think, that's not always particularly well understood. The common good is really emphasized. And it's an interesting anecdote I have there. Every year they have a meeting. It's called the Keidanren, and it's basically the government gets together the CEOs and management teams of, let's say, the top 12 or 1300 companies, and they say, this is what you're going to do with minimum wages this year. Wages are going to go up by X%. And everyone kind of follows suit and does, as they're asked. But it's this idea of collective good and watching out for your suppliers, your creditors, obviously your customers and employees, which is really prevalent and creates that durability, which is, bankruptcies and that sort of thing just don't tend to happen.
And yet the stock market has underperformed for an extended period of time.
Mm-hmm. Well, the ROEs suck. I mean, up until recently, and I think the changes that are happening now, a lot of them could end up being more one-time in nature. You have a dramatically overcapitalized balance sheet, you make it slightly less bad. Does that change every incremental capital allocation decision the management team are ever going to make? No, I mean, it doesn't. That's a deep cultural thing. But the reality is, yeah, if you pick the starting point of 1990, there's been a significant amount of underperformance. A lot of it is warranted by what has been pretty terrible returns on equity.
Plus overvaluation at that starting point, right?
Yeah, exactly. That was a pretty tough time to start. I think since 2012, the market's done probably quite well. So yeah, pick your starting point, but the valuations are still overall much better than what we can find. We're not particularly comfortable investing in a lot of emerging markets. There's a lot of places where we just don't understand what's going on. But from our perspective, Japan and actually the UK are probably the two markets where the valuations are most appealing and where we understand the rule of law, etc.
Just before we leave Japan, we were talking before we came on the three breweries in Japan. Have they seen the same? There's a trend away from macro to micro breweries and just a general secular decline in the consumption of alcohol generationally, I think. Have they seen the same problems that the rest of the world has faced? Are there microbreweries in Japan?
None that I know of. I mean, I know in the US you have is it Sam Adams and people like that who are listed.
Yeah.
I'm sure there are microbreweries which exist, but they're none that I know of which are listed. Sapporo is the more premium one. So there's Asahi, Kirin, and Sapporo, the big three. Sapporo is more premium. I think they've done better from a volume perspective, but Asahi and Kirin have seen persistent volume declines. In the case of Asahi, they've tried to offset that with acquisitions. So there was something in Australia called United Breweries, overpaid for the asset almost certainly. But they've been trying to diversify away from the core market and at least buy growth elsewhere with kind of mixed results on average.
And isn't that interesting? The 1980s Japan acquisition was incredibly, that was taking over the world, right? Like they were buying all these US assets, like everyone was worried about Japan taking over the world. Then obviously things got a little ahead of themselves valuation wise, leverage ratio wise. And then you pay the comeuppance of that for 30 years. But I don't feel like you've really seen that kind of return of, Japan Inc. doing a lot of global acquisitions as much.
Outbound deals. I mean, the trading companies have consistently done it, mostly in the commodity space, and they've done it quite effectively. So that they've done it, and then there's a certain Mr. Masayoshi Son.
Well, that's a good point. Yeah, I forgot about that.
He can't be stopped, but he's a bit of an anomaly. He views himself, I think, as an outsider in Japan. He's sort of ethnically Korean. He's got a bit of a chip on his shoulder in a lot of ways. But you're right, it's not as pervasive as it was in the 80s.
Can that souffle? Can that souffle rise a third time, do you think?
What, Massa? I think SoftBank will either be the biggest company in the world or bankrupt.
Yeah.
No in between.
That's bold. That's bold. Then.
It's that's the one prediction I'll make. I've been fortunate enough to meet him a couple of times in the past, and as well as some of the people who are running the Vision Fund, the CFO Goto-san, and Marcelo Claw, who was in charge of Sprint. It's now merged with Timo, obviously, but they're smart people, and you have to think about where Massa came from. It's been a bumpy ride, but he started off, I think he was at Berkeley, and he invented a sort of a pocket translator, which he sold to Sharp, I think that's right. And then he parlayed that into a reseller of software in Japan. Then he bought the sort of defunct Vodafone assets in Japan and turned that into a viable, really strong competitor in the mobile space there. He got away with Sprint. He kind of managed to somehow make it work. And then there's obviously Alibaba and now Arm are sort of relatively good. So he will almost certainly get close to bankruptcy again in the future. He just likes leverage too much. And I think it's his major flaw, along with trusting people who he thinks are similar to him. So kind of aggressive visionary types. So, Adam Newman.
Shiny eyes.
Yeah. He's not the best judge of character in my opinion, but he does make moves, and they've not all been terrible. So yeah, my call is huge or bankrupt.
It's kind of an inherent like martingale strategy. Just it's double or nothing. We're just
got to get him for
keep going.
Cents on the dollar when he's close to the bottom for the option, like ride back to the roof. Not when he's doing well.
I think he sort of, he's got these 100-year visions in terms of how he thinks the business will evolve and how the world might evolve around it. And then he's got, 4 months of liquidity at hand
to get there.
He's like,
clip that up.
Like a duration maturity mismatch going on there.
Let me give a quick shout out to the folks who are playing at home, and then JTT, you want to do some veggies?
Yes, sir.
The top of the hour. Danny Beltran, first in the house in Santo Domingo, Dominican Republic. How are you? Max in Valparaiso, Boise, Porto de Mos, Portugal, Dubai, Birmingham, Alabama. What's up? Boulogne, France, Breckenridge, Colorado, Toronto, Savonlinna, Finland, Tallahassee, Greensboro, Cleveland, Phoenix, Portsmouth, Brandon, Mendocino, Jupiter, Florida. You've already won. San Diego, Kennesaw, Georgia, Dublin, Ireland, Petah Tikva, Israel, Madeira Island, Portugal, Cincinnati, Les Winan in Boing Boing, Australia. That might be a real place. I have no idea. Bonnaroo, Alaska, Kingston, Jamaica. Nothing really dirty this time around.
They tricked you into saying Boing Boing.
Well, Les Winan's probably not a real name. But if there are good ones, I'll read them out. I'll read anything that's on the teleprompter.
Yeah.
All right, JT.
I'm Ron Burgundy.
Burgundy? Yeah, I am.
All right. So for today's veggie segment, in mathematics, there's this knot theory, which like KNOT, like actually studying knots and the mathematics behind knots. And it's really like these loops that are in three-dimensional space that they don't intersect with themselves. So think of it as taking a piece of string and tying into a loop and then joining the ends so it can't be undone. And there's actually like mathematical theories behind all this. And the main goal is really to classify and understand different types of knots and studying their properties and how they relate to each other. And there's these things about knots that don't change even when they're stretched and twisted, and these are then called knot invariants, like not changing basically. And so, for example, the number of crossings within a knot is an invariant, and counts how many times it crosses itself, right? Another important invariant is this Alexander polynomial, which it's like this mathematical tool that helps you distinguish between different knots. And keep that name in the back of your mind for a minute longer. Another thing is this thing called Takahashi manifolds, which are a special concept in knot theory named after Michio Takahashi. And these are three-dimensional spaces created from knots where they have this thing called DEN, D-E-H-N capitalized surgery. And this is a process where you like cut a knot and then kind of re-glue it back together in a new way to form different 3D spaces and unique properties. I don't understand any of this stuff. I'm just reading off the teleprompter. I'm just kidding. But there's actually some practical applications from all this, surprisingly. Like, so in theoretical physics, this knot theory helps understand these complex phenomena like quantum entanglement and how particles become interconnected in strange ways. And then also studying knots has actually led to improvements in how we allocate resources in complex systems like distribution networks. There's like really abstract concepts, but they actually can help in logistical planning. And so here's where things get a little bit weird and coincidental. Okay, remember those names, the Takahashi manifold and the Alexander polynomials? Okay, well, in the world of like large capital allocation, like endowments, there's a model that's used to help forecast cash flows for private equity and venture capital. And the name of that is the Takahashi Alexander model. And it was developed in 2001 by Dean Takahashi and Seth Alexander at Yale University. Now, how these, no relation to these mathematical knot people. So, I mean, what are the odds of that? I found that to be quite striking. And Yale, of course, is famous for David Swenson's trailblazing asset allocation models that he did. And Takahashi and Alexander were both Swenson acolytes, and Alexander now runs MIT's endowment. So what's this Takahashi Alexander model in the endowment world? It's a framework for estimating future cash flows and valuations in private equity and venture capital portfolios. And it can be really difficult for an allocator to plan because the money is typically called in chunks over the life, let's say the first 5 years of a 10-year fund. And then the next 5 years after that, the money's then distributed after these businesses are liquidated. So in the simplest terms, the model helps you figure out how much money you'll need to invest upfront and rolling as the investment period runs, and then when can you expect to get it back? And the analogy might be like if you're planning a road trip and you need to know how much gas you'll need to buy along the route. These are the capital calls, and then how many snacks you can afford to buy along the way, and these are kind of your distributions. And you don't want to end up stranded in Barstow with no gas money, right? So the Takahashi Alexander model helps you plan out this liquidity scheduling. So, you know, as George Box famously said, all models are wrong, but some are still useful. The TA model, it relies heavily on assumptions about the future contributions and distributions. So if you're wrong about those, then, you know, the model's going to give you pretty, you know, crap in, crap out, as the saying goes. And of course, it can lead to overconfidence in your predictions because it gives you like a single point estimate outcome and not really a range of probabilities. So, of course, people have taken that now and run like Monte Carlo simulations, lots of historical data inputted that helps you create a range of possible outcomes instead of just one single prediction. And that makes it a little bit more of a probabilistic kind of approach, which is probably an improvement. Now, let's see if we can wed knot theory and cash flow planning into some unholy matrimony.
Land it,
right.
JT.
I'm going to try. So a lot of the key lessons remain consistent between these two, like simplicity, like thinking about a simple knot or a simple cash flow planning can lead to incredible complexity. Interconnectedness matters. Models, you know, they always have to be you have to consider uncertainty in them. Simple loops can form very complex shapes. Just like kind of a straightforward asset allocation model can actually create very intricate patterns of cash flow modeling. And then, you know, just like these knot invariants that we talked about help maintain stability, like they're a common thing that don't change. You know, these models should have principles in them that can stay effective even when the market conditions are changing. So probably give that like a, you know, 6 out of 10 on the sticking the landing. But I just couldn't believe that there's this Takahashi Alexander, like they're both things in both knot math, which is like, who the hell's even ever looked at knot math before? And then also an obscure, you know, endowment model system. How'd that happen?
I think the Takahashi manifold in my Toyota has broken down. I'm taking it in for check
repairs.
up tomorrow. It's the Takahashi manifold again. It's always the Takahashi manifold.
It's interesting though. So does that mean that if there's a larger pool of committed but undrawn capital at private equity firms, the TA model effectively means that it becomes less risky because there's more predictability in the nature of the distributions?
I don't know. I mean, you know what it is. You know like what the numbers are going to be on the capital calls. You just don't know how quickly or slowly it's going to be. So there are these things in there that are called like bow factors that kind of account for like the speed of calling. And then of course, that can change a lot depending upon the strategy and the environment. So like, let's say that it was a buyout fund and there wasn't that much to be working on, and maybe they'd be slower, they're more conservative and to deploy, then you would know that, probably the calls are going to be further pushed out back, further out in time. So it's all just about modeling these calls and distributions. I don't know if you're really changing the risk as much though. And then of course the distribution part is under the assumption that you actually are able to sell the business, realize the capital, and then send it back to the LPs, that's not necessarily always a given either.
Yeah, well, continuation funds and stuff can happen.
If you can find someone else to sell it to, that is always an option, including yourself. That does happen for sure.
There's been this ongoing sort of investigation or query about whether that size premium ever existed, or if it didn't in fact exist, if it's gone away, and if the fact that it's gone away, if it's cyclical or secular. And then there's been some suggestion that private equity might have absorbed some of that size premium because they tend to pick off towards the very small end of the listed company space. I mean, would we see that show? Have private equity returns picked up enough to sort of cover over that disappearance of the returns in the small and large?
So you're saying public markets, small, might not actually be a positive factor historically now, like as we've extended the data series?
I think that it's possible that the underperformance has been so bad for such a long period of time that the premium has
previous premium.
I think the premium has gone away. And so the question then is, did it ever exist? If it did exist, has gone away. If it has gone away, is it cyclical or secular? And if you can answer that question correctly, you're going to make a lot of money.
Yeah.
I mean, I wouldn't suggest that it's private equity who have absorbed it. Most of the studies I've seen suggest that private equity's returns relative to the S&P, for example, have basically been, market return plus leverage minus fees, more or less. But it's market return as opposed to better than market return.
Yeah,
I guess it's a little bit of the definition too, because when we say private equity, I always think of buyout, but it's inconceivable that that's sitting in VC. And has VC done better than it has previously? We're asking at the wrong part of the cycle.
Yeah, VC's had a really good run for the last decade, especially. Now it remains to be seen whether that's going to continue. Like Bill Gurley had a post yesterday on Twitter that linked to an article that was talking about basically like the GPs, so the VC firms themselves and the businesses that they're buying and funding, and some of the mismatch that can happen there when when 2 and 20 is the model, and VC industry was relatively small, and so it was more really about the 20. Like the management fees were good for keeping the business going, but you wanted to get rich from like growing the pie, which is where the 20% carry kicked in, right? And everyone was sort of aligned when that was what you were optimizing for, was the carry. Like the GPs are getting rich because the fund's returning well, the LPs are doing well, and the businesses themselves are doing well because everyone's looking for like a big outcome. Well, as these funds have gotten bigger and bigger in the VC world, that 2% of a big ass number turns into like a pretty meaningful, nice way to get rich. And it's risk-free relative to the 20% carry. So when funds start optimizing for 2% instead of the 20, and then they're just kind of shoveling money out the door because they really only get paid on what's, money that's in the ground, then the GP and the business actually can kind of start to get mismatched as far as outcomes go. And maybe they're not going to pay as much attention to you because they don't care about the 20%, carry. It's just about getting the money out the door so that you can raise the next fund and get the asset base even bigger. So there's some questions on whether you're going to be able to have anything returns looking like what they look like for the 10 years before, when it was more about the 20 than the 2.
Ben, let me just read out a few. Bonnaroo, Alaska, Kingston, Jamaica, Leuven, Belgium, Helensburgh, Australia, Kansas City, just in case I missed those ones last time. From one smaller island nation with a pretty big industrial base to another one, Japan to England. What are the things that you like about England right now? Or is it just that you're finding individual names rather than more broader macro?
Well, it's not a macro call per se. I mean, we are comfortable with the rule of law here, and how business is generally done. It's the valuations which are most striking. I think the PE on the FTSE 250, which is the sort of smaller and mid-sized businesses, is around 12 times today. So within a developed market context, that kind of paints a broad picture that there might be some opportunity. And these are not, although there are some companies which are more, let's say, old economy, metal mining, banks, etc. That's sort of what the FTSE 100 is very much known for. There's a lot of innovation and globally relevant companies in the smaller side of things. So companies people may know, like Games Workshop, for example, are generally good at what they do. They operate in a niche, but they're a relevant company. So it's more on the micro side in general, but the broad macro and the valuations are definitely appealing. And I don't think I'm the only person who feels that way. I mean, you're seeing a huge amount of inbound M&A attempts in the UK. You saw Anglo American, there was Curry's, Rightmove, REA had tried to have a go, and a lot of these bids have been batted off. But it's quite clear to me that from a business owner perspective, there's opportunity in the UK. The people who are selling are, well, there's a few people, but a lot of it has been the domestic pension funds who, I mean, there is no home bias in UK domestic pension funds. I think their allocation to the UK equity market is 3 or 4%. It's kind of in line with global averages. So they have been the sellers, and the smart people, or at least trade buyers and corporate execs, have been the ones buying. And yeah, I think it's clear what side of that trade I'd want to be on.
What does it take for some sort of catalyst, or what does it take to turn it around? Is it enough that it just gets too cheap, or is there?
Yeah, it could just be corporate activity. I mean, it could be a combination of MBOs and M&A. That certainly seems to be the case right now. But UK companies in general are also relatively generous when it comes to dividends. So again, I think the average dividend yield for the FTSE 100 is 4.5% or so. So you're getting to a lot of the more traditional companies like the banks, NatWest, Barclays, etc. I mean, they're buying back shares at an incredible rate. I mean, NatWest over the past 5 years has probably bought back and retired around half of its equity capital base. So there's a few sort of external factors, and then there's management teams who, generally speaking, get it in a broad sense and do the right thing. So they're their own catalyst in a way. Other than that, no, I can't think of a specific thing that'll change the tide other than those two things.
Are you able to discuss any individual names? Do you discuss names, or you prefer to keep them to yourself?
There's a few which we've already discussed in public, so happy to sort of talk about them in broad terms again. But in the UK, for example, we have a position in two companies which we've talked about. One is Admiral Group. Admiral is
Geico of UK. That's what everyone says.
That's the generous interpretation. There are some nuances. The business was actually founded by an American in '94, a chap called Henry Engelhardt, and he started with one brand, 50-odd employees, and in the past 30 years or so has basically built Admiral into the largest P&C auto-focused insurer in the UK, with about 14 or 15% market share. It's measured by net written premium. So it's a wonderful business. They're quite unique when it comes to insurance, insofar as they reinsure 80% of their policies. And so they're actually able to generate something like 50% returns on equity, 50. because they don't have the same capital requirements as most insurers, and they use that capital efficiency to pay out basically most of earnings. 95% plus is paid out as dividends. Henry was famous for saying he thought basically management needed to have a gun to their head. They needed to feel some pain. They needed to realize that capital was constrained, and that would make the business run more efficiently and better. And it's worked. And
it's almost like a REIT at that point, practically, huh?
Pretty much. And it's not stopped them growing, vehicles insured in the UK by 7-8% a year consistently. They're based out in Wales, which is a lot cheaper than here around London. And I think 10 or 11,000 of the 12,000 total employees have some shares. So that dividend actually means something to them. They're vested in the success of the business. And those small things combined has meant, their combined ratio has averaged, say, 83% over the past decade. That's
good.
That's pretty darn impressive, if you ask.
Now, is it true that there are more losses in the UK because you guys drive on the wrong side of the road?
Same as Japan, mate. It must be something about it. Yeah, no. I'll tell you, make it serious. There has been claims inflation, but you've had the same elsewhere. Bodily injury claims, bent metal claims have been going up pretty consistently for everyone. Where we lag, or where Admiral lags versus the US, not so much Geico, but Progressive, is they don't really have a good telemetry offering. So there's definitely some work they can do there. But yeah.
That sounds just like Geico.
Yeah, it's a bit like Geico.
How do they go on the asset side of it? Do they, is it if you're investing locally, it's been a tougher run than some of the American insurers, which have had a
what's the float situation?
Yeah, well, because they reinsure a lot of the business, they do commute the contracts back onto their own balance sheet, typically after 3 years or so. But because they reinsure a lot of it, they don't actually hold that much of the capital. So the investment side of the operation, it's not like it doesn't matter at all. It's probably about £100 million a year of profit on. So it's pretty small. It's mostly about the underwriting.
It's almost more of a broker.
Yeah.
In that sense.
Yeah, exactly. They make a lot of money on the underwriting. They make quite a lot of money on the ancillaries. So sort of financing for premiums, that kind of thing. It's a little bit of a unique quirk of the British market in general. All of the peers, Direct Line, Aviva, they've all got that quite high skew towards more fee type income. It's the only way the market can be viable. It's probably more competitive than the US because there's a culture of going through price comparison websites in the UK. There's a lot of direct business. The pricing is fierce. You don't have the agent intermediaries who can smooth that out a little bit with relationships and that kind of thing.
How do they keep that? How do they keep that to 83%? How do they keep that so low?
Well, there is still a large part of the market that does use agents. It's not all direct in the UK. Agents are taking 10 to 15% commission on premium, so cutting them out is a good thing. And then otherwise, it really is. It's their call center is all in-house. It's based either in Cardiff or in Bangalore. It's just the cost focus there. But the biggest, most obvious one is you're cutting out any kind of intermediaries, which it's an advantage versus still half of the market.
And that's an interesting play. That's Admiral. And what's your other position?
Howden Joinery. So that is, I'm going to use Americanisms. Let's call it the Home Depot of the UK. It's a bit nuanced insofar as they just do B2B. So they sell kitchens, not particularly glamorous, but they have 30% overall market share of the kitchen market in the UK. They have 70% of the trade channel. So they're pretty dominant in what they do. I think they've got about 814 depots today. They say that the vast majority of tradespeople are within 5 miles of a Howdens. It's very important. If you're a tradesperson, price is a factor, but availability is probably an even more significant factor. But because of the way that they do business, they don't have expensive showrooms where they're showing kitchens on an open floor plan for retail. It's really a warehouse, very, very bare bones. That's what tradespeople care about. But it means their OPEX is much lower than people like B&Q in the UK who have a retail operation as well. And they have a private label business. So if you look at the supply chain for kitchens and joinery, kind of anywhere in the world, there's a company in Canada called Richelieu Hardware, which just does the wholesale. That is a very high margin business. The cost of failure is high. It's logistically complex. So they do about 35% of what they do in-house. They're vertically integrated. They build their own cabinets. They have their own wood sourcing and that kind of thing. So a combination of a better efficiency floor footprint and vertical integration kind of means they're able to run 60%-ish type gross profit margins, mid-teens EBIT margins, and still be offering a product which is materially cheaper than the next best out there. The most exciting, and it's relatively cheaply valued today. It's on sort of 18 times next 12 months earnings. Has been a bit cheaper in the past. We were able to buy it a little cheaper, fortunately. But the exciting thing there is they're really only scratching the surface of going outside of kitchens. So kitchens is where they're dominant today. It's still the vast majority of what they sell, but they're starting to experiment with bedrooms, bathrooms, flooring, all of that kind of stuff. And given the nature of the relationship they have with tradespeople, and given their logistics and the back hall that they have, there's a good chance that they're successful there, in my opinion.
That's another interesting one. If are you able to have you discussed any other Japanese holdings or any other international?
Yeah, we talked about. But be careful with this one. We've talked about some of the drugstores in Japan. In Japan, unlike the US, where Walgreens, CVS, or in the UK, Boots, or in Hong Kong, Watsons are sort of entirely dominant. In Japan, the drugstore market is still very fragmented. Kind of half of the market is made up by large players, the rest is independents. Not only that, drugstores in many cases are more like the hard discounters. They sell a lot of food and sundries at low prices. So the two drugstores which we own, Cosmos Pharmaceutical and Genki Drugstores, they both generate about 70-75% of their sales from food. So their drugstore is a bit of a misnomer in terms of what they do. And when it comes to retail, there's a pretty clear playbook as to what makes a good hard discounter. And it typically looks like low gross profit margins, i.e. good value for money for the customer, coupled with very low operating costs as a proportion of sales in order to be able to sustain those low prices. And you get growth, you get good same-store sales, that's positive working capital dynamics, and so on and so forth. And you end up being more durable and more resilient as a result of it. And those two I mentioned are both running around 20% gross profit margins. Cosmos around 3.5% EBIT, Genki around 5%. That's fully 10 points better on gross profit margin and 7 points better on SG&A as a percentage of sales than the vast majority of their competition in Japan, the big retailers like Aeon Group. So it's a model I like, and we think has led to some pretty fantastic outcomes over time. In the case of Cosmos especially, they're investing in new parts of Japan. So they've gone from the Western Island, Kyushu, then moving more into Kanto, which is Tokyo. That has been detrimental to margins over the near term. Margins have gone from 4.5% to that 3.5% level I mentioned. It takes a while for these stores to ramp up. They don't do marketing. They're relatively big box format. We've seen that playbook again. But the market has just extrapolated the trend and led to the stock trading on. In the case of Cosmos, 0.5 times EV to sales, 0.5 times. At a normal margin, that would be around, 8% owner earnings yield. And then the business is growing low teens, and probably can do for the foreseeable future. They've got 1,500 stores. If you extrapolate their store penetration in the western part of Japan to the other regions that they're starting to expand in, that leaves scope for 5,000, and still be tiny in the grand scheme of things.
Does Japan and England just see they've got lower multiples than the US sees, and those multiples have been going against them for an extended period of time, where I guess it's the same experience to some extent. That's been the experience in the small and micro and probably even mid cap in the US.
It's all flows, baby.
Yeah, everything's just if it's not Magnificent Seven, then it's just not getting much love anywhere. But that's I
mean, there's definitely some truth to it, but I don't know. Call me a hopeless romantic, but if you find these businesses which can truly compound over time at sort of decent rates, at some point someone becomes forced to agree, or you just make your money from the business. It's interesting. I was reading a study. I think it was Joel Tillinghast at Fidelity did the presentation on it. He ran the low price fund, but he did this thing showing Warren Buffett's quote unquote compounder investments. So I think it was Geico, Coke, maybe Wells was actually in there. I'm not sure, but it was sort of instructive to me. And Amex was in there. So and he sort of showed multiple Warren pays, multiple of prior peak earnings, which was very relevant to Geico and Amex at the time, and then multiple of earnings 3 years forward. So Coke was the most expensive at maybe 15 times. But 3 years forward, it was on 5 times. Geico was 2 times prior peak earnings and 1 times 3 years forward. So I mean, the point is, I think you can buy really good smaller businesses, maybe going under temporary troubles. If you're buying with that kind of margin of safety, let's say you're right.
That's the key. You have to be right about all.
You got to be right about it, and you got to be looking. Einhorn's talks about how markets are broken and you can't rely on the multiple to help you anymore. In those cases, and then those Warren investments, but still compounded great businesses. You didn't need the market to agree with you. You're going to make a return. And that might be a very high bar, trying to find great businesses on 1 times earnings. That's a pretty tough. It's not easy to find, but if that's your starting point and you work back from there, I think you can probably afford to let the multiple go against you for a while.
It's hard to get to that low multiple 3 years out when you start at 30 plus today. Like it's just, it's not easy.
But I'm going to self-flagellate a little bit. I mean, you think of Meta or Facebook at the time that IPO'd in 2012.
Yeah,
I remember that IPO was pretty vivid to me, because I remember it IPO'd at $30 a share, and then it had a bad couple of days, and then it kind of cracked, and everyone was talking about how Goldman's tried to prop up the share price. Probably troughed at 20. I know where we're at today, 500 or so. I don't know what the number is, but people were talking about a bubble back then in 2012 with Facebook's IPO. And I think Facebook Meta is probably going to earn $20 a share this year. So it's on 1 times, this is not 3 years forward, but 10 years forward type of thing. So, now you had to have perfect foresight. You had to have that insight to be able to say Meta could earn anything close to that kind of earnings power. That wasn't me. Maybe another guy could have made that judgment with some confidence.
No, I think it's a good point, well made, and it's something that all those Magnificent Seven have had periods of weakness over that last 10 years or so too, when they were all eminently viable. Google, certainly Meta, I think even Amazon have all had times when they were cheap and they could have been bought. I didn't, but maybe Meta.
Somebody
I got Meta.
Smart out there figured it out.
On that, Ben, that's time. It's been really great chatting to you. If folks want to follow along with what you're doing or send you a message, how do they go about doing that?
Check out our website. That's the best way. It's got all the contact detail and socials and everything. So it's tourbillonpartners.co.uk. And
I'll link that up because it's spelt a little differently to the way that it sounds.
Thanks, Tobias.
JT, any last words?
No, thanks, Ben, for coming on. It was a pleasure.
Ben Beneche, Tourbillon Partners, thank you very much. Folks, we'll be back this time next week.